Hello, this is Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. This video is going to take a deep fundamental look at Tractor Supply Company via the Fundamentals Analyzer software tool FastGraphs. Tractor Supply is an excellent growth stock that has amassed a very consistent record of above average earnings growth. The orange line on the graph plots Tractor Supply's earnings since 1998. A couple of very important things to focus on. Earnings have grown at 19.8% a year over this time frame, and the consistency of this earnings performance. Even during the Great Recession, they did have a minor glitch, if you will, or interruption in their earnings growth, but then it was followed by a staggering growth the following year. This is a terrific company with 30% debt and a great long-term growth history. Now, as Tractor Supply has grown, they started paying a dividend. They paid their first dividend in 2010, depicted by this white line, and you'll notice that that dividend has steadily increased every year since they started paying one. And I'm also going to display those dividends on top of the graph, which is important because in the long run, your total return is going to be a function of your price appreciation plus the dividend income that the investment is paying. But this stock has only been paying a dividend since 2010. Next, I'm going to add monthly closing stock prices to this graph, and there are a couple of important points that I would like to focus the viewer on. First of all, I want you to notice how the stock price essentially tracked earnings, which is the orange line on the graph, up through 2011. The correlations were very close with only minor periods where price got disconnected from the orange line, which is a reference of intrinsic value. Then we went through this extended period coming out of the Great Recession where the company's stock price had actually become very highly valued, or I would call it overvalued. And what's important for the reader to note here is that this can go on for a long time. There were the occasional hiccups, but eventually the rubber needs to meet the road, as they say. And what you see here is Tractor Supply was trading at very high price earnings multiples, 31 on May 31st, 2016. And during this entire time, my argument is that the stock is very vulnerable to a correction. And you can see that from its peak price of $96 on May 31st, 2016, that the stock has actually fallen or been cut in half almost 50%. Now, what's interesting about this is I believe the stock was overvalued to the extent that it should have been trading on the orange line as it did here. And then, of course, you'll notice a short-term rally. But more recently, the stock has fallen below the orange line, which indicates attractive valuation. If this stock were to go back to its normal 19.8 PE ratio, which is the PE ratio of this orange line, over the next year and a half or so, the total annualized rate of return could be over 33%, actually 50% total return over the entire time frame. So this is why I've showing you this stock, because I believe it's a great company with a great operating history that had become overvalued, and consequently, even though the business continued to perform well, it wasn't such a great investment over that time frame. And I also want to point out that growth continued pretty much unabated. The average growth since 2010 has still been a very above average 18.4%. But notice how the price stayed high here, and then all it took was a little bit of bad news, and that might be in the context of only a 4% expected earnings growth for this year to bring the stock down back to economic reality. Now, that's a quick look at the history of the company. Let's move on now to forecasting and talk about what we might be expecting for this company going forward. In order to do that, I'm going to turn to the forecasting calculators, the FastGraphs, and look at consensus analyst estimates for the stock over the next year or two. There are 25 analysts forecasting earnings of $3.40 for this year. That would only be a 4%, 3.98% to be precise, growth rate for this fiscal year, which, by the way, does end in December. However, that's 26 analysts also forecast growth to resume to 11.7%, and then 12%, followed by 14.5%. So this temporary slowdown in growth in my opinion, was the catalyst for bringing this previously overvalued stock back down to fair value territory. I'm next going to look at a longer term growth rate here, and there are only 4 analysts providing this longer term growth rate, but the trend line 3 to 5 year forecast growth rate for Tractor Supply is 15.25%. That would indicate that this company could offer very exceptional future rates of return if it traded at just simply a normal market multiple of 15. If the stock traded at its normal PE ratio of 26, which the market has historically been applying, the returns could be even better. And then also I would like to talk about how accurate analysts have been with forecasting this company's earnings. This is their record when they were making a forecast 1 year in advance. And what I want you to notice here, that the only time the analysts actually underestimated this company's earnings growth was during the recessionary period of 2007 and 8. Otherwise, they've been very, very accurate. The company has either met or beat earnings every year. So the long-term record, and then the similar for the 2-year forecast, the only misses, and they were rather substantial, were during the Great Recession. However, when you look at the overall record, analysts have been accurate, or I say it differently, the company has met or beat analyst estimates 87% of the time on the 1-year forward, and about 85% of the time on 2-year forward estimates. And all that means is that when I'm looking at these near-term estimates for the company, I have a pretty good feeling that analysts have been reasonably accurate in making these forecasts, which indicate this is a very undervalued company at this point in time. At this point, I would like to turn to fund graphs, or financial underlying numbers, and take a look at some very important metrics that I think should be considered when looking at a stock. This is the gross and net profit margin for Tractor Supply going back to 1996. What I really want you to focus on here is that their margin has actually been increasing on the gross side, as well as the net profit margin over recent years. I'll shorten the time frame so you can see this a little clearer. So the company produces really good gross margins, and for a retailer, they've been maintaining their net margins as well. That augurs well for the future. So to summarize and in conclusion, Tractor Supply has been an excellent company with excellent long-term growth. And I want you to notice that growth has actually been very strong since coming out of the Great Recession, and very consistent. They've increased their dividend every year since they started paying one. And by the way, their dividend has grown at an average of about 30% a year, which is obviously very high, but this is a company that's just started to pay a dividend. If you look at the long-term track record of this stock, even though it is currently very undervalued, you can see that it dramatically outperformed the overall market. Had you invested $10,000 in December of 1997, that $10,000 would be worth over $540,000 today, compared to investing the same amount in the S&P 500, which would have only turned $10,000 into $25,000. So this is a terrific opportunity to buy a great business that's currently gone on sale. However, as always, we recommend that you do your own research and due diligence. This has been Chuck Carnevale, the Chuck in the Market's Up Chuck. Thanks for listening.